Welcome to RealCrunch Real Estate Property Analysis Software, example number 2, Income Property, modeling a single-family rental property using RealCrunch. When the software opens, you'll end up on the property page, which you can notice up here in the navigation buttons. And on the property information page, we have our general info, which is data we need to identify the project, the required return, which is our hurdle rate for the project to be acceptable. And then we have purchase costs, everything we have to do in order to acquire the property, and then improvements, anything that has to be done to the property in order to make it leasable. So going back to the top, let's put in some general property info. You can put anything you want in there, anything to identify it. So for the name, we're just going to call this example 2. Location, I say somewhere. You don't have to put in the full address, just anything to help you remember where it is. Author me, and then issue date. Computer doesn't choose the date. It highlights today's date, but you can select any date you want for the final date or the actual issue. So we can say this is a July 24th model. Now note, we'll just say single family rental with repairs. Alright, this example we're doing it's just a single family rental, and it could be a apartment, it could be a single family house, doesn't matter for the example. And then our required return, 18%, we'll say, let's just say 19 for the example. Check what that needs to be, look into the support. Alright, purchase costs. Well, first line here is the property purchase value. This line you cannot delete, and you cannot change to a percent of purchase value because there's fixed and percent, but you can edit. So we added here, you can change the name, I just leave it a property cost. Input type will say fixed. Item cost, let's say our rental is going to cost us about $85,000, and notice throughout any numbers that we put in or edit, we have to, no currency sign, no commas. And okay, and then here's the broker's fee, it updates to 3%. Now this we can delete or we can edit. So we'll just edit, and let's just say it costs a little more, make that 5% also. And let's add one more thing. We can add additional expenses. We'll say home inspection, and we'll leave that a fixed cost, $500. And will the lender include this in the financing? No, nope, they won't. So that comes out of pocket. So yeah, that button there. It's an option. It deals with the first mortgage. So if the lender doesn't include it in the financing, then the amount that you put for the value ends up in the total cost, but not when you compute your total mortgage cost, because the lender won't count that towards the mortgage value. So, all right, let's move on further. Other thing to say is, see, fixed value. The purchase time is at 1 month. If you make this 2 months, then the purchase cost and the percent of purchase value is always on the last month. So month 1, these two don't show up, they'll show up in month 2. Now fixed values are distributed evenly over the purchase time. So if you have 2 months, the 500 is going to be split into 250, 250. So let's look down here, see we'd have our subtotal. We went from 85 now up to 89,750. Okay, on to improvements. Here we have improvement time set at 0 if we have no improvements, but we're going to add some. Say minor repairs, and say 3250. Again, no currency, no commas. And will the lender include it in the financing? No, he won't. Okay, so, and as always a little bit of landscape, and they won't include that either. Alright, so here's our initial model for the project. We have our general information, our required return, we have our purchase cost model and our improvement model, and they add up to 89 and the 5,000, and we get our total project cost of 95,000. Alright, next we're going to move to the cash flow and to see what type of income we can expect. On the cash flow page is where we put in all our data in order to find out if the property produces any income. And then also at the end we put up in our terminal velocity to see what we make on the sale. So this is all the income related to the property. If we look back down on the sheet here, first one, income. We have a holding period. Automatically it sets at 12 months. You can put that whatever you want. Let's just say, let's make it 3 years, 36 months. And also here, table values, monthly and yearly. This value will stay in months, but you can set these to change to year rates or monthly rate. We'll keep it a monthly, just easier to tally things. So let's add some income and just say we have rent and gross income, 1,000 a month. Vacancy loss, let's just say about 1%. That would be about a week or two a year. And then our growth rate would be 3%. Now growth rate here is, the yearly growth rate is a stepped rate. So after 12 months, this $1,000 is going to increase by 3%. It's not going to be constant, it's going to be a stepped profile. So we'll add that there. You can add more income. Let's say we're going to do the lawn. And we'll charge them $65 a month. And obviously there's no loss on that. So yearly growth rate, we will try to keep up with inflation. We'll say 2%. So there we go. So it takes off the vacancy loss for the year, or actually for the month, because we're still in month. And then we get our 65, and then shows us the total income. Now this is going to match the first year again, because you're going to have that 1.3% increase and 1.2 on the 65. But if you clicked over to yearly, it just changes these values into yearly values. This will be your total income for the year. But I just prefer months. Alright, expenses, let's add some. Here you can put in as many as you want. You can aggregate down to taxes and water bills and everything. Or if you want, and you know already what your percentage of gross income that goes to expensive, you can just hit percent of total income and put 40% or 20% or whatever number you use. So let's just aggregate and keep them fixed costs right now. So let's just do electric, because we're going to cover that for them. Let's say 110. And believe it or not, the inflation electric isn't that high down here. And we'll add, let's see, water. So we'll just add a few more things. And then we could say trash. And also here's where you want to put your property taxes. So that comes out of the NOI. And per month you just figure out, usually where we're at is about 2%. You have to check your local municipality, then just figure out what the yearly bill is divided by 12 to put in by month. So 167 gives us roughly close to 2,000 a month. Those don't really go up that month, so add 1%. So see, you get the idea is that you can add pretty much as you want. You can put different inflation rates on everything, and then it adds up here our total expenses. Now these aren't inflated, this is for like period month 1, so you can get a quick check. You get your income, you got your expense, and we got some NOI, it's positive, so we're looking good to go. The next thing we need to look at is the property sale. So going at the bottom of the page, we'll see here we have the sale price, which is the price that we'll settle on to sell the property. Let's say we 115,000. Again, no currency or commas. Sales time, we'll figure month. If you end up putting 2 months here, the actual sale will take place on the last month, similarly to our purchase price. And then down here we have the property sale costs, which are deducted from this. So we have the broker's fee. Once we click, it's automatically adjusted. So here you can delete this already. You can actually have no property cost, but let's go ahead and edit it and make it match. We were using 5%, so save that, readjust, and the total costs are removed from the sales price. So then we can add, let's do some minor maintenance and repairs. Just say we got a little bit of fixing up to do. Alright, so there we go. We have our total sales revenue. So we sell the property at the end of the holding period. After 36 months, we get $115,000. And after our property expenses, the costs in order to sell it are $6,000. We only end up with $108,700, and we're looking like we got a positive NOI, so things are looking good. Let's go see how we're going to finance this on the next tab. On the finance page is where we're going to do the project financing, and it allows us a pretty powerful page. It allows you to almost have an infinite amount of different types of project scenarios. But let's go down and look at the page here. First thing is our general info. You have the total project costs, which is all in with everything costs, and then the financeable project costs. And this is the only things, when you click that little yes or no box, will the lender include this in financing? When you say no, it's not included over here. So as far as the lender is concerned, based on your input, this is the value of the project, which they're going to apply the loan to value and these metrics and the inputs towards. So you got to know what they want to finance, and the rest is required equity in your pocket. So here's the primary lender, first mortgage, and it'd be a typical equity loan type scenario, primary lender. And then down here we have the equity stack. So we have our equity loans line of credit. Now this could be a second mortgage, or it could be credit cards or HELOCs or whatever type of loan type instruments on the equity side to help you start nipping away at that $23,600. And then down here we have investors that you can bring on board to also help you reduce your actual out-of-pocket contribution. And down here the remaining equity contribution is going to be whatever's left has to come out of either your company or yourself. So let's go back and put some values here. These are just sort of the variables that are pre-selected for the property. And you really need to check with your lender to see what these things change all the time, especially loan to value. And the amortization period, maybe they'll let you go to 30 if you're lucky. Sometimes on investment homes they stay low. Let's just make it 30 for here. Debt service coverage ratio, that's the ratio of your net operating income over the debt payment. And for investment properties, I like to see that a little bit up, so let's say 1.2. Interest rate per year, let's just leave it at 4. And closing costs, and closing costs are whatever you need to pay, the financing charges and whatnot in order to close the loan. Be sure to see if the closing costs are including the broker's fee, because we've already included that on the prior page. You don't want to pay twice. Alright, so here's our mortgage values, and the mortgage calculator shows that our maximum loan that we can get is $71,400 based on this financeable project cost. Here's our loan payment, closing costs, and the available capital actually towards our project expenses is $68,900. So now we need to come up with $26,100 of additional capital for the equity. So let's put in some equity loans. So I'm going to add my favorite creditor, Fast Eddie Loans, and let's say Fast Eddie was going to get us $15,000, no currency or commas, charge us a reasonable $2,500 fee, amortize his loan, 14% over 20 years, so that's only $188.73 a month, not too bad. So add that. So now we have $12,000 contributed out of the equity lines of source, and you look at the bottom, we need another $13,600. For the example's sake, let's just add a credit card. And for that, we're going to do $5,000. If you got an annual fee, you can put it in there, but usually no fees. Now, credit lines are continual sources. They're a little different, and because amortized loans, you pay up all your principal and debt, and it comes to an end. Credit lines tend to go on forever. And the minimum balance payment, you need to check inside the documentation, usually 2 to 3%, we'll say 3%, and you'll see the payment's $225. Alright, so let's add that. So now with our 2, we got $17,500 equity. Now we only need to put in $8,600. Let's add an investor, and we'll just say investor 1. Of course, you put anything in there. Say we want to split it, so he's going to give us $4,300. And revenue sharing. So here you can just either give them a fixed payment per month, or you can do a percentage. We'll do percentage, let's say, since he's putting up halves, give them half, and that's only if there's any income left over. If there's no income left over, no payment. Profit sharing percentage, let's say we want to give him 30%, and then the return requirements. Now, this is his IRR based on the cash flow. And if the investor has a minimum threshold over the whole project, what's going to happen is this number is going to supersede this one. So although you might get 30% of the profit, this is going to make sure that when you take the whole timeline of his returns, that he makes 30% IRR per year, called a look-back IRR. So let's say he's hemmed and hawed and we have to put a 30% look-back. Alright, let's add them. Okay, so there we go. Now, $4,300, the remaining, now this is a little deceiving, but in this stack here we have $4,300, but any shortfalls that you'll see next comes out of our pockets. So, alright, let's go on. Next we'll go to the perform button to see how the project does.